Welcome to a new era of personalized investing, where private investors understand that true value lies beyond mere relative performance. Amity recognizes that investing is a deeply personal journey, and success is not just about numbers. Discover a refreshing approach to investing that prioritizes clients' goals and well-being. Unlike ordinary investment options, we are dedicated to a true outcomes-based strategy, bringing certainty to investment outcomes. Don't settle for the ordinary. Embrace the future of predictability and certainty with our outcomes-based investment approach. At Amity, we believe in delivering personalized solutions crafted specifically for advisors' clients, understanding their risk appetite, goals, and preferences. Join us now and unlock the potential of a more rewarding and fulfilling investment experience that goes beyond the mere performance and places the client and their aspirations at the center of everything we do. Reduce uncertainty with outcomes-based investing. Amity Investment Solutions.
It is becoming more and more evident that suitability will play a crucial role in the financial planning environment. Risk profiling in the traditional sense won't suffice, and additional questionnaires or tools will have to be considered. Knowing your clients in terms of KYC and truly knowing your clients, their biases, understanding of financial products, even in some instances their background and history with money, becomes very important when doing proper financial planning. That said, it is not just a question of whether your client understands the products they enter into or the fund they select, but whether you, the advisor, understands all the intricacies of the instrument. While investors and advisors have a fair understanding of traditional asset classes, it is becoming increasingly important for many industry participants to understand alternative asset classes in order to diversify their portfolios in the current market environment. We've been asked many times what our view is on hedge funds and whether we will consider to include hedge funds in our range of model portfolios. Now, for anyone on this webinar today who is not familiar with Amity, we are known as a boutique discretionary fund manager focusing on outcomes-based model portfolios. We subscribe to the financial planning philosophy termed goals-based financial planning. This said, we manage portfolios and construct portfolios very differently from many traditional DFMs and most probably many Cat 2 advisors or multi-managers. I can clearly state upfront that we don't argue for or against hedge funds, and we will always use the complete universe of funds available for selection when considering fund managers. Given all the questions we receive from advisors on hedge funds, such as whether the high fees are fair, can it be included for any type of clients, how do I select a hedge fund, what are the risks involved, we decided to host a series of webinars this month to provide you with valuable content and enable, equip, and empower you, the advisor, to truly understand this asset class. We will meet some exceptional investment professionals who will share some great content with us. But first, to start off this series, today, let's maybe just discuss the basics. Let's take it one step back. What is a hedge fund? In very plain, simple layman terms, it is a mix of investment strategies suited for rising and falling market conditions. It often invests across various asset classes, and in addition to traditional buy and hold and sell strategies, hedge funds can include short selling, leverage, arbitrage, derivatives, all to minimize risk, optimize returns, or in some instances to do both. Now, it is interesting that it is very often uncorrelated with traditional asset classes, and for this reason deemed a very good diversifier. A CISA reported that in 2022, we've seen the hedge fund space really grow. There are two different types, called QIF, or Qualified Investor Hedge Funds, and RIFs, known as Retail Hedge Funds. This little chart illustrates the increase in the number of funds. They measure the data over 3 periods, December 2021, June 2022, and then December 2022. Now, over this period, you can also see how the NAV has changed for both QIFs and RIFs. Now, it seems clear that there has been a huge growth in specifically the retail hedge fund space. Hedge News Africa reported in March this year that the South African hedge fund industry grew its assets by 30% in 2022, ending the year with 113 billion rand under management. Now, this includes all of the Cisco-regulated type of hedge fund structures. Now, as list providers are now more willing to offer hedge funds on their platforms, it has become also more accessible for many advisors. Now, interesting is that we all have biases. We have had some webinars on behavioral finance earlier this year as well, and I think it is clear that even for those of you who decided to attend today's session, there's a very good chance that you joined this morning's session with a certain belief and a certain view on hedge funds. According to various articles, there are many misconceptions when it comes to hedge funds. One such misconception is that investors view hedge funds as opportunities to gain exceptional market returns, even in failing markets. While there are those that view hedge funds as very risky. Now, in some instances, that may be the case when, for instance, they take on severe leverage positions. But most probably, most of these ideas are because of a lack of knowledge. If we don't truly understand something, it is very easy to have these misconceptions. But also, given the overly technical nature of hedge funds, it can also be quite overwhelming for someone to firstly understand hedge funds, especially if you don't work with it on a day-to-day basis, and secondly, to know hedge funds, translate this, and then to share it with, for instance, your end client. Now, we've compiled a very nice template of all the lingo and jargon used in this space, which we hope to share with you at the end of this webinar, and we believe it can add tremendous value. Now, some of the words that you'll probably hear throughout the series would be words such as leverage, long and short positions, net exposures, and options. Some of the other technical aspects would most probably be the type of hedge fund structures out there. Now, there are long and short equity structures, market neutral, fixed income, statistical arbitrage, volatility arbitrage, multi-strategy, and commodity structures. Mostly in South Africa, and mostly with the bigger asset management names, we see them making use of your long and short equity type strategies. Now, considering regulation and industry specifics in South Africa, it's interesting to note that South Africa was the first country in the world to implement comprehensive regulation back in 2015 for hedge fund products. But the question is, can it be used in any product and for any client? Now, at current, Regulation 28 allows for 10% allocation to hedge funds. This means that for most pre-retirement plans, you could potentially consider to include this for a client that's still in that accumulation phase. Now, it's also no longer only accessible for your high net worth clients or institutional clients. Retail hedge funds were specifically aimed at the retail market, and this too is the reason now for the differences in QIFs versus RIFs. Maybe just a side note, if you do look at hedge fund returns, just make sure that it is not the QIF's returns being illustrated. Often, given the track records, this may be the case. And as a retail hedge fund would in most instances follow a lower risk strategy and look slightly different than a QIF version, we would like you to ensure that when you do your due diligence, make sure that you don't get influenced by the return numbers alone. Now, again, the differences between the two would be that a retirement fund would typically be someone that's able to invest as a qualified investor, whereas advisors will typically allocate as a retail investor. Now, there's thus some valid arguments also for inclusion of hedge funds in living annuity portfolios. And later on in the series, as we'll progress, we'll hopefully touch a bit on this aspect as well. So it does seem it has become a much more regulated industry. So there goes that myth out the door. Another myth, perhaps, is that all hedge funds are risky, some a bit more than others. Now, as I mentioned earlier, with the types of hedge fund strategies, most in South Africa use a long-short strategy. Now, this type of strategy is known to actually reduce volatility. There are, of course, exceptions where hedge funds manage very concentrated, highly geared portfolios. But these are not the norm. While there are still a number of highly aggressive hedge funds in South Africa, these are typically single mandates, run for clients that can tolerate that type of risk. Leveraging lucrative positions can actually provide geared exposure, which can be attractive from an investor's perspective. But this feature is very unique to hedge funds, seeing that traditional long-only portfolios do not employ leverage. So again, from a financial planning perspective, my question is, should advisors then consider including hedge funds? Well, firstly, you should understand the hedge funds that's available to you for use. What type of hedge fund strategies do they follow? Are you comfortable with the fees charged? Because remember, even if we can validate a higher fee, it doesn't necessarily look very attractive on those EAC quote schedules from the LISPs. Again, like we've argued many times before, if you have a proper CIP document in place, it becomes much clearer to know exactly where hedge funds can and should be considered in your clients' portfolios. And in all honesty, don't go at this alone. Be sure to have a person, a team, a DFM to assist you with the research and implementation. While in conversation with some of the industry experts, I was actually made aware of a very important point, that hedge funds, unlike your long-only CIS type traditional funds, should not be categorized or grouped according to their fund name. The naming convention often doesn't translate to the strategy, which doesn't talk to the risks. Now, this makes for a very interesting dilemma, and the reason why we implore you to talk to some investment professionals when starting to invest in hedge funds. And this is the fact that you struggle to benchmark these hedge funds, and only once you've maybe built some composite custom benchmark will you be able to measure hedge funds on a like-for-like basis. Now, if you now want to start doing asset class characteristics, can you imagine the difficulty, as hedge funds aren't just deemed a group or cannot just be deemed as a specific type of asset class because of these finer nuances. Optimizing portfolios remain important. It is something we all strive to do, but never at the expense of risk management and always considering what is best for the client. So maybe in closing, I'd like to highlight some issues or pitfalls that you should be aware of. Firstly, transparency. Even with this industry becoming more and more regulated, transparency is not yet where it should be. Even for our own team of analysts to be able to do the same work they do in the long-only space is becoming or is more difficult. Secondly, taxation. Recently, we've seen SARS tax a hedge fund as they started trading CFDs. Mancos are now concerned for including hedge funds in CIS structures, so this could still be a very grey area. And then finally, liquidity. We should know that hedge funds do place restrictions on their AUM. And if you, for instance, have a house view to use a specific hedge fund and they start to cap that hedge fund, it becomes administratively unpleasant. But ladies and gentlemen, you are probably on this webinar today to also listen to our first guest speaker and one of our investment professionals that we asked to participate in this series of webinars. Now, he's the head of asset management at Anchor Group Capital, the hedge fund arm of the business, and one of the co-fund managers. And Henry will share with us their thoughts on optimizing portfolios with the use of hedge funds. Thank you so much, Henry, for participating.
Hey guys, Tanya from Amity has asked me to spend some time with you talking through the merits of including hedge funds in your client's portfolio. And I think this is a great time to be talking about hedge funds, not just because we think they'll be one of the better performing asset classes over the next couple of years, but also because recent regulatory and industry efforts have made them more accessible than ever. And in fact, if we look through the South African savings and investment landscape, we feel they're actually one of the most underutilized asset classes out there. And I guess there are two primary reasons for this, and I just want to talk through those reasons. So firstly, I think accessibility has been an issue. Previously, hedge funds had high investment minimums. They weren't broadly available across the major LISPs, and they weren't very liquid. At best, you had kind of monthly liquidity. But that issue's largely been addressed. So today you can invest in our hedge funds with as little as 1,000 Rand. Most of the major hedge funds are daily priced. We've all adopted the retail investor hedge fund structure. Most major hedge funds, including our own, are broadly available across most major LISPs. And also importantly, we've seen the creation of a large number of really credible multi-strategy and multi-manager solutions, which take the complexity of investing in hedge funds out of the process for individual clients, but also for advisors. But secondly, I think the main reasons why hedge funds are underutilized is that they're still viewed as a little bit of a black box space. That hedge funds sit at the riskier end of the investment spectrum. And I think it comes back down to the first principles of investing. And when you're looking at the construction of a client's portfolio or your own portfolio, a natural place to start is the consideration or the relationship between risk and return. And we instinctively view that relationship as a linear one. So in other words, you can't improve the returns of a portfolio without introducing more risk into that portfolio. But there's some nuance to that relationship between risk and return, which is actually really super important, especially when looking at the hedge fund space. So if we take decades of market data and we graph that relationship between risk and return, it actually approximates the U-shaped curve that you're seeing on your screen right now. And the important implication of this curve is that it is actually possible to improve the return profile of your portfolio while reducing the variability of those returns, or in other words, while reducing the amount of risk inherent in the portfolio. So to look at how that's possible, I just want to look at the three portfolios that exist at the three extremities of this chart. And the first one is portfolio A. Now that demonstrates the lowest return with a moderate level of risk. And this is a very typical portfolio that consists around 50% in stocks and 50% in bonds. Portfolio C generates the highest return of all of these portfolios, but of course that comes with a much higher degree of risk, and these are typically portfolios which make use of a degree of leverage. And portfolio B is really the portfolio that I want to focus on. That's the portfolio which I call the optimal portfolio, which generates the highest level of return per unit of risk. And typically these are portfolios that incorporate between 15 and 20% in hedge funds, if we look at empirical data going back 40 or 50 years. And this is really the critical line of thinking that I want to introduce to those of you who haven't made use of hedge funds before. And this is data that we can dig into with you at a later stage if you like. We can model it on Morningstar, whatever platform you're using, and we can actually demonstrate that by introducing a moderate allocation to hedge funds, the risk-adjusted performance of most portfolios will actually improve. But moving on, let's look at why exactly hedge funds are such risk-efficient investment vehicles. Well, firstly, they have access to a more diverse toolkit. They have the ability to go short. In other words, they can profit from stocks or positions when they decrease in value. They have the ability to hedge out explicit risks. A good example in our market would be the ability to hedge out the Naspers, the 10-cent exposure out of Naspers, creating a very clean investment into the rump of their venture capital portfolio. And thirdly, they also have the ability to use option structures to limit losses. So, I mean, if we look at today's market where the S&P is up, 16 or 17%, with the Nasdaq's up almost 30%, this is a great time to be locking in those gains. Hedge funds can actually make use of option structures to lock in those profits. So if something does happen, if the market does correct, you don't give all of those gains back. Secondly, importantly, hedge funds are less dependent on market direction. And actually, they thrive in volatility. And the JSE is a great example. So in a market that over time is very volatile, but actually delivers zero or close to zero returns, hedge funds can actually make decent profits. Secondly, they also benefit from the phenomenon of compounding. So because of the absolute and consistent nature of the returns that hedge funds generate, over time, they tend to outperform. And I'll show you some data a little bit later on that supports that argument. And then lastly, I think it's worth talking about how hedge fund managers are paid. So I guess this is somewhat of a controversial issue when talking to most advisors. A lot of the guys have an issue with the TIC inherent in a hedge fund. They're much more expensive products than your traditional long-only solutions, and that tends to put people off. But I think an important point to make is that a large component of a hedge fund manager's compensation is determined by their performance. Okay, so in other words, they don't earn if the fund doesn't outperform the benchmark. And we actually think that this is a good thing. It creates a laser-like focus on generating both consistent and absolute returns, and a focus on generating returns that are well in excess of the selected benchmark. So I think a convincing argument around the practical application of hedge funds is to look at a South African long-short strategy. This is one of our own, the AG Rainbow Fund. But you could use many of the other South African long-short strategies in the market as an example as well, compared to the total return of the JSE All-Share Index going all the way back to the beginning of 2018 as measured in dollars. So importantly, we think that most of our clients should measure their growth in wealth in dollars. It's a much more stable currency in real terms. And if you have a look at this chart, you can see that the all-share over 5 years is basically flat, but a South African long-short strategy operating in the same market, trading the same stocks that make up that index, has given you a cumulative return of 42% in dollars. And I think this is a great practical illustration of the benefits of including a hedge fund in your client portfolios. But the problem with this is, how on earth do you predict which hedge fund is going to outperform? In the absence of a crystal ball, it's almost impossible. And that's why we really advocate the use of a multi-managed or a multi-strategy solution. And really, that's where we recommend most of you start. And that's because it mitigates manager selection error, exactly what we're talking about. So why bet the farm with one manager when you can invest across a selection of managers and you will achieve, well, you'll benefit from diversification. Secondly, a multi-strategy fund or a multi-manager fund will take care of the correlation analysis for you. So it's no good investing across a group of managers who all perform in the same way at the same time. Then you don't benefit from diversification at all. A multi-strategy or a multi-manager fund will make sure that the different managers complement one another to ensure that you achieve an optimized outcome at the end of a reasonable period of time. And then, of course, there's the issue of being able to consistently rebalance the fund in a tax-efficient way. So a multi-manager can rebalance the fund across the different managers without creating tax consequences for your clients. And they can also do it quite cost efficiently as well, at least. So these three factors, I think, almost always combine to create they result in a superior risk-adjusted outcome. So by way of illustration, this is our own multi-strategy solution, the AG Fusion Fund. And what I've tried to do here is to show you the cumulative return of our multi-strat fund compared to the cumulative return of all of the underlying funds, going back to December 2020. But what I really want to emphasize is that despite the fact that the fund has performed quite well relative to the all-share index, importantly, okay, you've mitigated almost all of the manager selection error. So have a look at the massive difference between the cumulative return of the best and the worst strategy on this chart. It's over 100%. And that's the risk you take as a financial advisor when you're choosing an individual manager. But by going with a multi-strategy approach, you almost always come out the other end with a good middle of the road outcome. And I think that's really what you want to aim for with your clients. The other point I want to make is that the longer you're invested with hedge funds, the better you'll benefit from them. And that's because of the consistent and absolute nature of the returns that they generate due to the phenomenon of compounding. And that's, of course, a force that we're all familiar with. So have a look at this cross-section of our own group's hedge funds, and you can see that as we progress through longer periods of time, from 1 year through to 3 years through to 5 years, you can see so the annualized returns start to improve. And that's because they generate consistent returns, absolute returns, and over time, the compounding effect starts to multiply. So if this discussion has rung a bell with you, I encourage you to talk to us or to talk to Amity. At the end of the day, the market has a broad range of hedge funds that are available to you, ranging from conservative to aggressive. You've got South African-oriented, European-oriented, and USA-oriented strategies. There are also some very competitive and very credible multi-strategy solutions out there. Most of these funds are available across the major lists now, which makes them easier to access. One point I will make, I think hedge funds are very applicable and very relevant to living annuities at this point in time. Just given the absolute and consistent nature of the returns, they're very well suited to a product where you've got very regular and very predictable redemptions. And yet we've noticed that hedge funds are underutilized in that space. So maybe that's something to think about. And then lastly, I'll make the point that Regulation 28 compliant portfolios can now include hedge funds, and I think it's really important to consider doing so. Up to 2.5% in an individual hedge fund, up to 5% in a single hedge fund of funds, and up to 10% across the category. 10% doesn't sound like a lot, but believe me, go and do the back testing. I can help you with that, or Amity can help you with that. A 10% allocation to hedge funds in a Reg 28 compliant portfolio over the last 5 years has made a tremendously positive difference to the outcome for the investor. Guys, that's it from me today. Thanks for your time.
Thank you to Anchor for their participation in this webinar. Join us next week when Almien Wagenaar from Think Capital will be continuing the discussion on hedge funds.